Hello everyone, my name is Fabiola. Then the purpose of this video is to go over chapter 11 of our course textbook. We will be describing and going over the equity section of our balance sheet, and we will begin by discussing the basics of capital stock. Capital stock is ownership in a corporation. A corporation issues shares or stock to its stockholders, usually in exchange for cash or some other asset contributed to the corporation. There are two things we need to go over of our capital stock, and is authorized stock and issued stock. Now, authorized stock is the total amount of stock that a corporation is authorized to sell, usually by the state's charter. It's very specific to the state. Every state has different regulations. Capital stock issued, however, is the amount of stock that has actually been sold. Moving on, there is something called par value of capital stock, and this is an amount assigned to each share of stock when authorized. Think of it as minimum legal capital. It is usually the least amount that buyers of stock must contribute. It is important to note that par value does not equal market price for a stock. Market price is the amount that each share of stock will sell for in the open market. There are a few classes of stock. We just went over par value. There is something called no par value stock, in that many states do not require a par value when stock is issued. There is something called stated value, and in many states, companies assign a stated value to no par shares. When common stock is issued from a company, there are two important numbers. The first one is the par value of stock. That is what we are going to be recording the stock for, because that is what it's valued as. However, just because it's valued at $10 and we put a set value on this stock, that doesn't mean that's what it's going to sell for out in the open market. So in this example, we go over a sale of 300 shares of $10 par stock for $13. So in this instance, we will debit cash. We will take our 300 shares and multiply it by the market value of $13. That is the amount of cash received. We credit common stock for the par value of the stock, the stated value. And the excess will be credited to an account called paid in capital in excess of par. And that is the difference between the par value stock and the market price of the stock that we just sold. So in this case, the corporation will credit $3 per share into the paid in capital in excess of par account. And that will be your normal plug account in your journal entries. Okay, so just a few more examples. In this illustration, we have a corporation that issues 2,000 shares of $1 par value common stock. We want to prepare the journal entry if 1,000 shares are issued at $1 per share, and when 1,000 shares are issued for $5 per share. So when stock is exchanged for cash, the corporation's cash goes up. So we will debit that and we will credit common stock for the same amount. For example B, we do the exact same thing. We're going to debit cash and we're going to multiply the $5 sales price by the 1,000 shares. We are going to credit common stock for the par value of the stock. Remember, the par value is $1 per share. That is a stated value that the corporation gave their stock. However, just because a shareholder was willing to pay $5 for the common stock, the remainder gets credited to the paid-in capital in excess of par account. This is just more examples. Here is the balance sheet presentation of common stock and paid-in capital in excess of par. Paid-in capital in excess of par is also abbreviated APIC, APIC, and that is what I will be referring to it going forward. So common stock is recorded on the balance sheet, and as you can see here, there are 50,000 shares that are authorized, but that doesn't mean that is the amount that we have sold. That is the amount that the corporation is legally authorized to put out into the market. Moving on, it says 30,000 shares are actually issued and outstanding. Common stock is reported on the balance sheet at par value. However, we still have a balance in our APIC account, and that amount is usually reported right under common stock, also in the equity section of a balance sheet. A corporation might also issue common stock in exchange for services or non-cash assets, usually for services or for buildings, some sort of non-cash assets. Cost is either the fair market value of the consideration given up or the fair market value of the consideration received, whichever is more clearly determinable. In this example, a corporation is an existing publicly held corporation. Its $5 par value stock is actively traded at $8 per share. The company issues 10,000 shares of stock to acquire land recently advertised for sale, at $90,000. Prepare the journal entry for this transaction. We will debit land for 80,000, and that is taking the 10,000 shares and multiplying it by the $8 market value. We are going to credit common stock for par value, 10,000 times $5 per share, and we will credit the remainder to the APIC account for $30,000. Going over just one more example, on June 10th, 4,000 shares of $20 par value stock for land valued at $105,000. You will debit land for the $105,000. You will credit common stock for the amount of shares multiplied by the par value, which would be 4,000 shares times $20 par value, and you will credit the remainder to the APIC account. Just to go over a few more examples while you're here. Example A corporation issues 80 shares of $5 par value common stock for $700 cash. You will debit cash for the amount received. You will credit common stock for the amount of shares sold times par value. That gives you 400. And the remainder is credited to the APIC account, $300. Example number 2, a corporation issued 40 shares of no par common stock to its promoters in exchange for their efforts, estimated to be worth $800. The stock has a $1 per share stated value. You will debit organization expenses for the amount estimated. In this example, it is $800. You will credit common stock for the number of shares multiplied by the stated value, $1. The remainder will be credited to your APIC account. In example number 3, a corporation issued 40 shares of no par stock in exchange for land, estimated to be worth $800. The stock has no stated value. In this example, you will debit land and you will credit common stock for $800. Lastly, a corporation issued 20 shares of $30 par value preferred stock for $900 cash. Again, you will debit cash for the amount of cash received. You will credit preferred stock for its par value, and you will credit the remainder to the APIC account. Now we will go over cash dividends. This is the fun stuff. This is when a corporation distributes its net income to shareholders. Now, there are two journal entries that we need to record when a corporation declares and distributes dividends. I know some of you are purchasing stock out in the open market. I've discussed this in class a few times before. Sometimes you'll get a notification from your brokerage account that you have received a dividend, usually in small amounts, depending on how many shares you own in a corporation. But for example, I remember, I believe it was Microsoft would issue dividends every so often, and I would get a notification that I have received a $2 dividend from Microsoft, so on and so forth. It really just depends on the amount of investment you have in the company. So moving on, there are two journal entries to record when a cash dividend is declared and distributed. The first one is when a cash dividend is declared. This is when the board of directors of a company decides to issue a cash dividend. This is not usually not the same date that the dividend is actually paid. So when we declare a cash dividend, we debit our retained earnings to reduce retained earnings because you are distributing the income, and you will credit dividends payable, which is a liability to the corporation. And the reason you debit retained earnings is because you are distributing the net income of the company. Remember, the retained earnings account is a cumulative account of a company's net income over the years. And it has a normal credit balance. So in order to reduce retained earnings, we do so with a debit. When the cash dividend is actually paid, you reduce the liability by debiting the dividends payable account because it is no longer a liability, and you credit the corporation's cash because the corporation is giving cash to shareholders, so it reduces cash with a credit. Regular cash dividends provide a return to investors and almost always affect the stock's market value. To pay a cash dividend, the corporation must have a sufficient balance in its retained earnings and the cash necessary to pay the dividend. There are three important dates for cash dividends. The first is the date of declaration. This is where we record a liability for the dividend. There is something called the date of record. No entry is required. And finally, we have the date of payment. This is when we record payment of cash to stockholders. This is when cash is actually given to the stockholders. Going over an example, on December 1st, the directors of Media General declare a 50-cent per share cash dividend on 100,000 shares of $10 par common stock. The dividend is payable on January 20th to shareholders of record on December 22nd. On December 1st, also known as the declaration date, we reduce retained earnings and we credit dividends payable to record our liability. There is no entry on the date of record. However, on January 20th, when the dividend is actually paid, you debit dividends payable and you credit cash for the corporation. There is something called stock dividends, and this is a pro rata distribution of the corporation's own stock. So the number of shares owned increases, but the percentage of the company owned remains the same. This results in a decrease in retained earnings and an increase to paid-in capital. Corporations issue stock dividends to satisfy stockholders' dividend expectations without spending actual cash. This increases the marketability of the corporation's stock, and it emphasizes that a portion of the stockholders' equity has been permanently reinvested into the business. There are two types of stock dividends. The first is considered a small stock dividend, where less than 20 to 25% of the corporation's issued stock is distributed. When a corporation issues stock dividends, and it is a small stock dividend, it is recorded on the books at fair market value. This is very important because we also have something called a large stock dividend, and that is when greater than 20 to 25% of issued stock is distributed. This is recorded at par value. So a small stock dividend is recorded at fair market value, and a large dividend is recorded at par value. This is a very important slide. Some journal entries for declaring a small stock dividend. We debit retained earnings. We credit something called the common stock dividends distributable account for par value, and we credit the remainder to the paid-in capital in excess of par account. When the stock dividend is distributed, we debit the common stock dividends distributable account and we credit the common stock account. Notice how cash is not recorded in any of these transactions. All of these accounts are equity accounts, even the common stock dividends distributable account. It is reported on the equity section of a balance sheet. Now, when we declare a large stock dividend, we debit retained earnings and we credit common stock dividends distributable. In this example, Medland Corporation has a balance of $300,000 in retained earnings. It declares a 10% stock dividend on its $50,000 shares of $10 par value common stock. The current fair market value of its stock is $15 per share. This is a small stock dividend. So we debit retained earnings for the $50,000 shares times 10%. The 10% comes from the stock dividend declared, and we multiply it by the fair market value of the share, which is $15, because this is a small stock dividend. We credit common stock dividends distributable. The remainder gets credited to the APIC account. When the stock is actually issued, we debit the common stock dividends distributable account and we credit common stock. Moving on to a large stock dividend example, Quest Incorporated has $10,000 shares of $10 par stock outstanding. On 12/31, Quest declared a 30% stock dividend. The stock will be distributed to stockholders on January 20th, 2014. The 12/31 journal entry debits retained earnings. We take our 10,000 shares, multiply it by the 30% stock dividend, and multiply it by the par value. We credit common stock dividends distributable. The effects from a large stock dividend on balance sheet accounts are similar to those for a small stock dividend, except for the absence of any effect on paid-in capital in excess of par. When the stock is actually issued, we debit the common stock dividends distributable account and we credit common stock. So The presentation on the balance sheet is as follows. Common stock, and then we follow that by including the common stock dividends distributable amount, and we report the total in the equity section of our balance sheet. Just want you to take a look at the effect of stock dividends. Before the dividend, we have $800,000 of total stockholders' equity. And after the dividend, the stock dividend, we still have $800,000 worth in stockholder equity. The only difference is the number of outstanding shares.